the hidden trap of market volatility. Why panic selling destroys retirement savings when the stock market is on a steady climb? Retirement planning feels straightforward. Investors often rely on historical averages, assuming the upward trend will continue indefinitely. However, the real test of a retirement strategy isn't how it performs during a bull market, but how it survives a recession. Economic downturns bring a wave of alarming headlines that can trigger emotional decision-making. For many retirees, this psychological pressure leads to a single, catastrophic error that can permanently compromise their financial future. The cost of panic. Selling at the wrong time, according to Wenjia Liu, a certified financial analyst, CFA, at Teapot Investments, the most damaging mistake during market volatility is selling investments prematurely. This is particularly dangerous when it involves illiquid assets investments that are difficult to convert into cash quickly. In a market downturn, these assets often sell for significantly less than their actual fair value. This behavior is a primary reason why the average retail investor often underperforms major benchmarks like the S&P 500. Data from DALBAR's annual studies consistently show that when markets become volatile, investors abandon their long-term strategies, selling low and missing the eventual recovery. Building a defense. The importance of a written plan to combat the impulse to panic. Financial experts emphasize that a strategy must be documented before the crisis hits. Daniel Gillam of Farther suggests that a robust retirement plan should not just be a general idea, but a formal written document that explicitly outlines selling strategies, specific rules for when and how to liquidate assets, withdrawal rates, clear guidelines on how much money to take out each year, rebalancing protocols, how to adjust the portfolio to maintain the desired risk level, tax loss harvesting, strategies to use market losses to offset future tax liabilities. Without these predefined rules, investors are left to make high-stakes decisions based on fear rather than logic. Managing sequence of returns. Risk, one of the most critical concepts for those entering retirement, is sequence of returns risk. This refers to the danger of experiencing a market downturn in the very early years of retirement. If you withdraw large sums of money while your portfolio is shrinking, you deplete your principal so significantly that the fund may never recover, even when the market rebounds. To mitigate this risk, experts suggest two primary tactics: flexible withdrawal rates rather than withdrawing a fixed dollar amount every month. Jared Stahls of Diversified Insurance Brokers recommends adjusting spending during market corrections. By shrinking your withdrawals when the market is down, you avoid locking in losses and preserve your nest egg for the recovery phase. Strategic asset allocation. During the high-risk early years of retirement, it may be prudent to hold a smaller allocation of stocks. Moving a portion of the portfolio into more stable assets provides a buffer, allowing the retiree to draw from cash or bonds during downturns rather than being forced to sell stocks at depressed prices. The bottom line: protecting a retirement fund during volatility requires moving from emotional reactions to disciplined, pre-planned actions, specifically by adjusting spending and avoiding the urge to sell during market lows.